All right, well, welcome today to today's Forte Financial Mortgage Podcast, and we have a very special guest this week, Anthony Yorio, the attorney. He's an attorney at law in Danbury, Connecticut. He's our real estate attorney that we refer as much of our business to as we can for lots of reasons, which we'll get into today. We have a lot of exciting stuff to talk about regarding refinances, some of the special refinances that we offer that it would be nice for you to hear it from Attorney Yorio, who's actually conducting a lot of these closings. Anthony, why don't you also tell us a little bit more about what you do? You know, I've worked with you for 15 years. I've used you for all my own personal services, referred my clients to you. Tell us a little bit more about some of the other services you offer before we get into some of the specifics.
All right, great. Thanks. First of all, James, thanks so much for having me here today with you. This is a great opportunity to talk about some of the things that we do almost on a daily basis for our clients that really, yield some great results for their investments, whether it be their home or their investment portfolio. My practice is mainly focused in real estate advising, and real estate investing. I do have a section of my practice that is dedicated to litigation, so we do all forms of personal injury and other litigation matters, but that really puts us in a unique perspective when we deal with real estate transactions, because we're always looking at it from the lens of the transactions that don't go as they should. Litigators are said to live their lives in the margins of where everybody else lives, right? 99% of the time things go wonderfully, but there's that 1% of the time that it doesn't. And it's always those 1% that create the problems for people. So we bring that unique perspective to every real estate transaction we're engaged in. So that sets us apart from many of our colleagues in the profession, because we do both transactional and litigation work. But today, I'd really like to talk to you about the common questions I get as a real estate attorney. When do I refinance? What makes sense? Is there a percentage difference from where I am today to where you can refinance me in a mortgage loan that makes sense when I take into consideration all the other variables that come into a refinance? What should I be considering?
Well, that's a great question, and I love this question because there's so many misconceptions and just false assumptions that I hear a lot. Oh, you have to save 1 full percent or more in order for to make sense to refinance, or I've here 2%. Those assumptions are based on someone thinking that there's thousands of dollars in closing costs that they're incurring to achieve that refinance, when that is not always the case. In fact, one of the things that you're aware of that we specialize in is our no-cost refinance, where we actually provide a lender credit which covers the actual cost of the loan, netting the borrower a zero-cost loan. So in that case, if you're only saving 0.5% on the rate, it still makes sense to do, because there's no time where you have to stay in it to save that. Like, let's say you're saving $200 a month on a refinance and you had closing cost of $5,000. I mean, that's a couple years you have to stay in that loan to pay off that $5,000 cost. But if it's zero, you've saved on day one. So, every scenario is different. But to answer your question, I think as little as 0.5% in a rate would make perfect sense in that scenario. Even less if it's a bigger loan. But yeah, you don't need to save a full percent to make sense when it's not costing you anything to get.
Yeah, we've seen plenty of those loans with you where it truly is a no closing cost loan. The lender doesn't, of course, cover the carrying costs like your taxes and your insurance, but the origination charges, the other mechanics that go into those raw costs that go into originating a loan. I've seen your company absorb or waive over and over and over again to make it make sense when it's as little as 5%, a 0.5% savings, a 0.5 point that is on any refinance, whether it's an investment or residential loan. Another reluctance I hear from some of my clients is, gosh, I'm 3 or 4 years into my 30-year loan, and while it makes sense to refinance, the real savings is because they just reset my loan back to 30 years, right? So now I'm taking that principal and I'm back to where I started again. So it's not real savings. I'm lowering my payment because I just elongated my loan again. Tell us, can you really keep the loan term where it is, like a 26-year loan at the newer rate, and really show that difference in savings?
Absolutely. I love this. Yes, because your traditional lenders don't offer what's called an odd term. So we offer odd term, and I mean odd term. Like we can do a loan that's, in your example, let's say they're 3.5 years in. We can literally do a loan that's 26 years and 6 months. It doesn't even have to be to the year. So we can set the term at whatever the borrower wants. So they don't have to go back to the 30 years. They can stay exactly where they are. And I have some people that say, James, saving $180 a month costs me nothing with your lender credits sounds great, but the monthly payment is not really bothering me. Say, okay, great. Well, how about, for an example, instead of keeping your loan term the same or resetting it back to 30 years, why don't we keep your payment the same, but at that same payment and the rate being much less, that may save you another 3 years or 2.5 years of payments at that same payment. So now you've taken it from a 26.5-year loan down to maybe 23.5 or 24 years, whatever that is, and you've kept your payment the same, but instead of having 26.5 years, you have 24. So we get very creative. We'll do whatever, and that's the thing. We take the time to make sure we understand what the customer wants, what's most important. Most people will just say, I just want to save as much as I can, but I like to provide them with, hey, here's that scenario, and it's free or no cost. We'll say no cost. And and then let's talk about that for a minute, the free part. What's not free is that in many cases, the borrower will bring money to the closing, but it's not because they're paying a cost. There's a lot of things that happen, as you can explain it probably better than I can. With when you refinance a loan, you have to reestablish an escrow account. And in your existing loans being paid off, there is an escrow account that has money of yours in it. Now, every lender is a little different when we pay them off. Some will actually, which is wonderful when they do this, they will subtract the escrow balance you have off of their payoff to make the payoff less, which is great. Others, they'll wait till they're paid off and they'll send a check to you after the account is paid off, usually within about 2 weeks, is give or take. They mail it to you. So that's where it's like, okay, I tell the customer, if you want to keep your loan amount the same because there's no, cost, you were going to have to fund the escrow account, but knowing that you're going to get this $3,000 back in, a couple weeks after you close, and you're going to skip a mortgage payment technically, are you comfortable bringing about, $3,000 or $4,000, whatever it is, to the table? And most people are like, yeah, absolutely, because I'm not making the next month payment and I am getting this escrow refund back. A lot of people will want to do that, but we don't even have to do that. We can add that money into the loan if they want to say, oh, well, consider it cash out. I want to use that difference to do a renovation or something. So, but yeah, I think we got a little off topic there. Sorry.
Yeah, so maybe just to explain escrows a bit, and if you don't mind, I'll take the reins on that since you afforded me the opportunity. Yeah, escrows are really just the taxes and insurance that are annualized for the property, and you pay 1/12 of that each month with your monthly mortgage payment. That's what we mean by escrows when we talk about that separate account. And lots of folks get confused because they think they're, oftentimes the lender is holding that money. Sometimes it's even a third-party servicer that's assisting the lender in managing the loan. They hold that money in escrow for the purpose of paying those obligations as they come due. And this is always a subject of a short explanation in every closing we do, what that escrow account means, how it's dispersed throughout the year, and then, of course, if you refinance, how you reestablish an escrow account with a new lender, and what happens to the money in that escrow account with your old lender. Does it come to you? Does it come off of your payoff? And if it does come to you, when does it come? And how much am I going to get? And so all of those things, when we do a refinance, are explained either through your office or mine when we get closer to the closing. And it would just be unrealistic to expect that a lender would actually pay that portion of your closing expense, because those are really carrying costs related to your home ownership, irrespective of whether you have a mortgage loan. So, yeah, that's a great PSA there on escrows and why you have them and what they do and how they work. But when we talk about these refinances, you started to discuss a moment ago about the term and how that can really affect your monthly payment. Are there times when shortening the term, in other words, going from a 30-year to a 20 or a 15-year loan, can actually help your rate? In other words, would I have a better rate at 15 years than maybe a 30-year loan? Absolutely.
Typically, on average, a 15-year fixed rate is about 0.5% lower than a 30-year fixed rate. A jump down to 20 years is usually about 0.1%, not that much. Again, there's some programs that will vary a little more, but your traditional 30-year fixed is typically about 1/8 in rate savings on a 20-year, but 0.5% off of the 30-year for 15. So, yes, if the payment isn't necessarily a problem for the borrower and it's max savings and they're comfortable with the payment on a 15-year loan, then definitely they'll save a lot more money, in terms of interest, and it goes, yeah.
So it seems like there's a real opportunity if somebody has, say, 6 or 7 years into a 30-year loan. In other words, they have 23 or 24 years remaining. That might be a candidate for somebody to go to a 20-year financing scenario if they're saving 0.5 point on their interest. Now, looking back in the market, realistically, interest rates 6 or 7 years ago were great. But I did recall in that period of time, we had a few loans that were adjustable rate mortgages. And if those loans are adjusting on a 7/1 adjustable rate mortgage term, and you're at 23 years and you're just now seeing the effect of the increases in an adjustable rate at year 7, and you're considering a fixed rate mortgage, where would somebody be today, say, if they had good credit, somebody north of 700 on a credit score, where would they be today if they went to a 20-year mortgage in that scenario in terms of interest rate?
So right now, depending on the loan to value credit score, the exact loan amount, you would be right around 6% on a 30-year fixed right now on something like that. We've locked in customers very recently on 30-year fixed rate loans that were A borrowers at like 6 1/8. So that same scenario, would have easily been, and these were 0-point loans, by the way. These were not loans that the customers were paying points to obtain these rates. This is clearly not a rate advertisement. We're talking generally speaking here, of course. But yeah, that's definitely, we have loans that, if the customer wanted to buy their rate down with paying some fees, we can easily get them in the 5s, for your A borrower based on today's rates and terms.
So just for a point of clarification, explain what a point is.
Yeah, a point is, in the sense there's origination points and discount points. So typically when we talk about buying the rate down, we're talking about discount points. So 1 point equals 1% of your loan amount, and you can buy. And it doesn't have to say, it has to be 1 point or 2 points. You can do 1/4 of a point or 3/8 of a point. You can buy to buy down your interest rate. Now, there's not an exact, hey, for every 1/4 of a point I pay, I get X amount off the rate. It doesn't work like that. Every, what we call coupon, is a different cost difference from the next. So let's just say we're talking about rates in eighths. So 6%, 6 1/8, 6 1/4. Each eighth difference is not necessarily the same cost as the previous eighth difference. So it's just one of those things where we have to look at the scenario exactly and then provide the customer with, hey, here's your options if you wanted to buy down the rate. Here's the 0-point rate is X. For 1/4 of a point, you can buy it down to this. For 0.5 point to this, or whatever. And we'll just give them those options if they're interested. In this environment, though, we're not advising that people do that, because anything can happen, and I'm certainly have no crystal ball like we talk about, but I think that the writing is on the wall that these rates will continue to come down. And the beautiful thing about the no-cost refinance is that if they do it now, and then in 6 months from now, these rates are another 0.5% lower. Well, that's great. We could do it again because they didn't cost them anything to obtain it 6 months ago. They're not vested. We can do it again and do the same no-cost deal for them again. So that's why I'm trying not to promote points, but if someone wants it, I'm happy to give it to them if that's what they want, but I just don't think that's wise in this environment, but that's not for me to decide.
So a common question is that I get is, how many times can I refinance? And then given that scenario, how soon can I refinance after I've just refinanced?
It's a good question. So these loans assuming we're talking about your traditional loans like conventional, FHA, VA type of loans, they have no prepayment penalties. So technically there is no waiting period. However, depending on the programs, there's some differences within, like for FHA, for example, and one of the things we've promoted a lot are the FHA Streamlines, and those to do a Streamline, which is basically a very limited documentation loan, no income, no appraisal, none of that. You have to have shown that you've made 6 payments on time before you qualify for a Streamline. So in that case, your wait time is about 7 months because your first payment isn't due for at least 30 days after you closed. So about 7 months in a Streamline. But our own personal internal policy, if we've done a free no-cost refinance for you, we have to wait 6 months from closing to the new closing to do it again. We cannot do it. We can start the process, a month ahead of time, definitely, or even 6 weeks ahead of time and get everything prepped, get everything done through underwriting, and just, we have to close on month, as soon as it's 180 days, we can close. That's just our own internal policy.
All right. Another question I get oftentimes is, what's the difference between FHA and conventional? That question always comes up because borrowers look at that premium that they have to pay for that upfront mortgage insurance, and then they compare that to a conventional loan, which doesn't necessarily have that large a premium to pay upfront. In some instances, not at all. So why would somebody choose an FHA loan, or why would they end up in an FHA loan versus a conventional loan? So if you could just tell us what the difference is between the two, and then why you would recommend a borrower be in one product versus the other.
Yeah, I think that every scenario is going to warrant one or the other. The reason why I feel like we've moved a little bit away from FHA more to conventional recently is because there's definitely been some changes within the conventional guidelines where if somebody is at a certain income level and they make less than a certain amount, there's what's called LLPAs. They're adjustments to the rates. There's caps. There's adjustment caps if your income is under a certain level. So if you have someone that's only wants to put 3% down on a purchase, so the conventional low down payment option, which is similar to FHA's 3 versus FHA's 3.5. But the negative to the conventional is you can't make more than a certain amount of money based on the town, county you're in, and if you do, then if in that case, if you do and your credit score is not stellar, the FHA is going to make a lot more sense, and I'll get into why in a quick second. But so there's really a lot of differences. Like you said, the main difference why people think FHA isn't good is because there's a 1 3/4% upfront mortgage insurance. It's 1 3/4% of the loan amount that's added to the loan balance. It's financed in, so the borrower doesn't have to come out of pocket with a check for that money, but it is technically a fee to the FHA, which is added onto the loan. It's 1 3/4%. So in a way, it's like paying 1 3/4 points on a conventional loan in that case. But the flip side on why someone may want to do that is because you can have a very poor credit score and get pretty much the same rate on an FHA loan within reason as someone with a 780 credit score on an FHA loan. Whereas on conventional, it's a dramatic difference. If you have a low credit score with conventional and you're not under that income limit, it is not going to make sense because, first of all, there's the mortgage insurance rate on a conventional loan with a low credit score and a low down payment it's going to be at least double what the FHA mortgage insurance, meaning monthly. and the rate is going to be significantly higher. So what I like to do when somebody is, of course, when they're asking what the difference is, I'll give them both scenarios. I'll show them, say, here's what it looks like FHA, here's what it looks like conventional. This is my advice for these reasons, but whatever you want to do is what we're going to do. And I try to I try not to overcomplicate situations either, where if someone's not asking me about a program and I know that it doesn't make sense for their situation, I'm not going to suggest or even bring it up because it's just overcomplicating it, when I know it doesn't make sense for them. So, but those are some of the differences. I mean, there's a lot more we can get into, but did that answer what you were?
Absolutely.
Okay.
So it brings me to the next question about real estate investing. What if a borrower came into your office and said, "Hey, I want to borrow money to buy this multifamily house, but it's my first house, and I'm going to live in one unit, and I'm going to get some income from these other two units. It may be more house than I think I could afford, but it's got rental income, and I want to add that to my income." Is that a scenario that is a viable lending scenario for your office?
It absolutely is, and I'm so glad you brought that up because there's actually been some changes with Fannie Mae specifically. So for conventional loans, we can actually now lend, up to a 4-family. It can't go over 4, but up to a 4-family, as long as the borrower is going to live in one of the units. And let's say they want to live in one and rent the other 3 out. We can do that now with 5% down, where it used to be 20 and 25% down for that type of scenario, and everyone had to go FHA because FHA is always allowed on a 4-family house to only put 3.5% down. That's been that way for a long time with FHA, but now they can do it with conventional with 5, which is really cool. So, like you said, let's get back to the qualification piece. I love this because I know if someone educated me on this when I bought my first house, 25 years ago, I would have absolutely bought a multifamily because just because you make enough money, let's say that you can afford $150,000 condo, but you don't think you can afford more than that, well, you actually can because we're going to take the rental income from the other units and we're going to give you 75% of that rental income as income on your income schedule to calculate your debt to income ratio. So that will help you qualify. We'll give you rental income credit as well, even if it's currently vacant, because when we do an appraisal on the property, part of a multifamily appraisal is a rent schedule. So they do an analysis of rents in the area to figure out what the market rent is for that unit, and we'll give 75% of that vacant unit market rent as well. So yeah, absolutely. It's a great opportunity. I would love to see more first-time buyers do this kind of thing. Maybe you need to be a little bit more, get your hands dirty a little bit. But it's definitely a great opportunity to own an investment property. And then, hey, a couple years from now, you want to start a family, you want to go buy that single-family house, you can go do that and then rent out the unit that you were living in for the last few years. Now you have a 4-family that's fully rented out that could be paying for most of your single-family house now and helping you pay for that. It's a really cool thing. I'm really glad you brought that up.
I feel like you were in a fly on my wall every time I have a borrower under 25 years of age in my office because it's the very conversation we have. I wish somebody had showed me when I was 18, 19, 20 years old and had the opportunity to buy a multifamily because it really truly is the way to ascend to a real estate investing wealth portfolio to start it young. Because if you're buying your first multifamily in your low 20s and you keep that home for 7 or 8 or 9 years and then you spring out by the time you're say 30 years old to your single family house, you'll have, if you buy it properly, you'll have 2 homes where you're living mortgage free.
It's amazing.
Because the folks that are renting from you are actually paying the carrying costs on both your principal residence as well as your investment. And by the way, by the time you're 45 or so, that multifamily won't even have a mortgage, and it's 100% income producing, net of expenses, of course. But I've actually modeled some of these things, and it reminds me of the conversations that wealth advisors have when they say buy buy life insurance when you're 1 year old, and look at the return on your investment by the time you're 18 or 30, what that annuity looks like. It's very much the same for real estate investing. If you can get a decade and a half ahead of your first home purchase when you're in your 20s and you make it an income-producing property that you also live in, it's just a tremendously powerful tool by the time you reach your middle or late 30s. I feel like we've entered a generation right now where, many behind us are thinking they can't even own a home, that they, they're so straddled with student loan debt and other obligations that there's just not an opportunity for them to ever own a home. And I feel like that they're not really well advised on the fact that there are programs out there that could help you irrespective of credit score, as long as you have income and as long as you have, a down payment that's about 3%, 3.5%, you can get into your first home. Isn't that right?
Absolutely. Absolutely. And before we talk about that real quick, I just want to address one of the reasons why I think a lot of the younger generation doesn't want to take on a multifamily, even though that they've been advised they can do this with 3.5% out of their pocket, is because they're nervous about being a landlord. And I'd love, for them to know that there's an option for them to have someone like you help them and help manage that. And if there's issues with tenants, what to do. If you can maybe share with the audience a little bit about what that looks like, from you, I think that might get them a little more excited about the possibility.
Yeah, so it's something that I'm really passionate about in that section of my practice. When I see people in developing a real estate portfolio, it is always the obstacle. And there are different models for how we can make that work for them. Some are impactful on your return investment, but others are really just, taking care of your own home, really. Because if you're living there, you're going to have to cut grass, you're going to have to replace a roof, you're going to have to do all the things that are attendant to home ownership. But if it's a multifamily unit, you're able to take care of the home for 3 people and derive income from 2 while you're living there. But when it comes to the not so pleasantries of owning real estate, it really comes down to whether or not your tenants are going to pay the rent. At the end of the day, the cash flow is what you look for out of your investment when you consider how much you're going to pay for it. We call that our capitalization rate. We look at how soon we're going to recover the investment on the money we've got invested in the property vis-a-vis the rental income that it generates. And that is something that's significantly impacted, as you might imagine, when people stop paying the rent. So we do provide counseling right at the closing table on here's what we're doing next. Here's your action plan. Here's a set of documents that you can use as a landlord to deal with not only the leasehold, in other words, the lease you're going to put your tenants in, but when it doesn't go well, and what your action plan is and milestones for those things to have occurred. So when do I first give my tenant a notice to quit? What is the reasons for the notice to quit, the statutory purposes that I can evict somebody? What does it look like beyond that? How much security deposit can I collect? What if the security deposit's inadequate? What are the tenant's rights if they're over, say, age 62? What are my obligations as a landlord to provide essential services within the home, like heat, running water, all of those things? And so we counsel on all of those things, the extent to which you can self-help, the extent to which you have to engage a lawyer, the extent to which you should actually have professionals completing certain aspects of work, like mold remediation and other health and safety type concerns in the home. We see this pretty frequently. People will have a one-family house and they think that they can convert a section of it into a second unit, and they never legalize it. They put a tenant in that unit, and before you know it, that person stops paying, but it's not a code-compliant 2-family home, and now they're stuck. And those are the kinds of things we advise people against. Before you buy this multifamily unit, we're going to make sure that it's legal. We're going to make sure that the units themselves have been authorized and approved by the township in which the home is situated. And we set you up for success from the first day. So That's a real, that's a part of real estate investing that really gets us excited in the office because, we've got a number of clients that we've advised on their first home, and they grew it to their second and their third, and a truly successful portfolio in a decade's worth of time. We always liken that type of real estate investing to a road trip. If you've ever taken a 3,000-mile car ride, the hardest miles are the first ones, right?
Yeah.
It seems like as you're driving down the street, every mile just sort of clicks on the odometer, and it's like watching, a pot of water come to a boil. It just takes forever. But somewhere along the line, the miles just start turning, and you're in a rhythm. And before you know it, you're halfway there. And the second half of the journey is always faster than the first half. Maybe the last 10 miles, but that's just because the kids are screaming in the car. But when we talk about real estate investing, you got to get on the road, right? Mm-hmm. Start early, and that's the analogy to buy young, right? When you're in your low 20s, you should be buying your first real estate investment. And then stay on the path. Don't get detoured. Don't stop along the way, because the only way you're going to turn miles is to make sure you're paying that mortgage every month and reducing your principal balance. Before you know it, you've established enough equity or miles on the odometer to start making your way to your financial destination, which is the end of that journey where you own the property, all the income that's coming out of it is yours. And now, if you think about what you earn for a living each year, to double your income, right? That's like having a second income earner doing the same thing you're doing every day to get out, only they're not doing it, right? The money's just showing up at the end of the month. Now, they're not just showing up, right? You have to put some work in. No investment is truly passive. It requires your participation. Mm-hmm. But the journey gets easier when you get to the second half.
Absolutely. So. That's awesome. Thank you. For viewers listening, you're even thinking about investing or just buying your first home, Yorio Law Group will advise you. I mean, this has been awesome. I really appreciate you being on this. It's been very educational.
Absolutely. And, as far as lending partners go, it's very, very difficult to make your way in real estate investing without a good lending partner.
Yeah.
One of the things that we do collectively, and I know our clients appreciate it, is we watch their rates. If we know you've closed at an inopportune time in the market and an opportunity does arise for you along the way, you'll get an email or a phone call saying, hey, rates just dropped a half a point. I know where you are with your rate. Consider refinancing. And they value that relationship. I know you remember their names. It's shocking to me how somebody we can close a loan 12 or 13 or 14 years ago, I call you up and I say, hey, you remember so-and-so? Oh, yeah, they bought in blah, 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 and we did this and we did that. Yeah, I remember them. Well, they need to refinance now. You don't get that in the big banks. You don't get that even in some of the community banks. Faces and change in places, and you're just another number on their client list. When it comes to Forte Financial, it always surprises me how many names you remember and circumstances. So I know clients really appreciate that relationship.
Thank you. We talk about real estate investing, and this is one of the things that we do so much of in terms of special types of loans for investors who, a lot of people who own a lot of real estate, they don't necessarily want to show their tax returns, or maybe they can qualify with their tax returns, but it's way too much effort for them to provide, countless documents. So we have a very aggressive program, which we've closed a few of, the DSCR, where there's no tax returns and it's just based on the income and expenses on the property, where, the rates are a lot lower than people think. I mean, we've got some with rates in the sixes on an adjustable rate, and 30-year fixed, in the low sevens right now, and stuff like that with no tax returns. Mm-hmm. So I mean, it's I know you have a lot of investor clients that love this stuff. So I don't know if you want to talk a little bit on this.
Yeah.
Topic.
So the scenario we see pretty often right now is that because interest rates were so low for so long, and now they've just sort of sharply risen. Some of our investors are saying, hey, now's not really a great time for me to buy. There's not a lot of inventory, so demand is very high. Premiums are being demanded by sellers that don't really present an opportunity. And so investors have sort of taken a little bit of a sideline. But it's always good to pay attention to what's going on in the market. There's always a value out there somewhere. Maybe it's a good opportunity to diversify your portfolio a bit. So something that we see right now is investors that want to become more and more passive in their investment. They've got a couple of multifamilies, and they think, okay, this is a lot of work. I've got to get out and shovel the snow and cut the grass, or I'm paying a vendor to do that. Why don't I just have condos? And then they'll buy a condo, but they'll buy multiple condos in the same condominium complex. And it feels like a 2 or a 3 or a 4 family because they've got 2, 3, or 4 units, but it's in the same condo complex, and they don't have to have the type of involvement with the property that they normally have. Of course, the return on investment might be impacted a bit by the common charges, but that's a trade-off for not having to take care of the other exterior maintenance issues that are attendant to a multifamily. So there are opportunities there for investors in that scenario, and they should think about accessing the equity in the multifamily that they've established during this period of time when interest rates were very low. So if you are in a, say, 40 or 50% equity position, they come see you to take out, say, 20% on that investment property and use it for either A, a down payment, or B, a full purchase price acquisition of some of these lesser involved, type investments like a condominium complex.
That's great, because that also brings up another thought there. A lot of investors are hesitant to want to pull equity out because they go, oh, well, I have a 3.5% or 4% rate on this mortgage right now, and now I'm going to go up, a lot if I take money out. That's not necessarily the case, because we actually offer second mortgages in terms of a loan or a line of credit for investment properties, which, I know most lenders don't do that on investment properties, or it's just limited if they do. So that's something else, for investors that might be listening, we can take a look at that if that's your concern.
That's a tremendously valuable tool, because when we talk about investment properties and what I like to dub the doubler, the doubler comes in when you reach a 50 or 60% equity position in your first real estate investment, and you're able to go out and buy the next property without taking a dollar out of your pocket. You're just going to take some of the equity out of the first investment and use it for the down payment in the next, and set up the same sort of debt to income and equity ratio that you had in the first property when you bought the first property. The nice part about that is if you stay on track with that for 7 or 8 or 10 years, then you could do both properties at the same time for another doubler. And you keep doing the same thing over and over again, and over a 30 or 40 year period of time, by the time you reach the age of retirement, if you're continually doing these doublers every 7 to 10 years, you've got a very sizable portfolio with a pretty good equity position in the end. It brings you to a point where we have to start talking about what 1031 exchanges look like and all of those things, which are really a whole nother podcast in and of itself. But it's the kind of advising that we do. But again, if you don't have a great lending partner that's paying attention to where your investments are, what your equity positions are doing, and then how you could re-leverage those things to expand your return on investment, you're really just, engaging a service agent who's going to provide you a single service and walk away. That's the real difference that I think that you get when you talk to when we talk to your office, is that you're monitoring. You're saying, hey, I remember we bought this investment property 6 or 7 years ago. You probably have a good equity position in it. What do you think about expanding your investment portfolio? That's the conversations that I think bring real value and real difference when you use Forte Financial. Because if you could start to use that equity to your advantage to increase the cash flow, which at the end of the day is really what real estate investing is about. What kind of money am I going to draw out of my investment every month? That's a person who's looking out for your interest. And I feel like clients I've referred to you through the years get that service on their investment portfolio when they use you.
I appreciate it. And likewise, everyone that I've sent to you, the amount of times I hear from them, oh, Anthony Yorio is doing this for us now. We have him doing our will. We have him doing, all this other stuff. And it's just a testament to the quality of service you give, because I think one of the things people love about you, aside from your knowledge, which is really second to none, because I've this is not a shot at anybody, but I've worked a lot of real estate attorneys, and the service that I see they get from you and the advice and how you look out for them is different. It's just different, and I'm going to leave it at that. But you explain it to people in English, and sometimes clients, especially newer clients, younger, less experienced, are very intimidated when they speak to an attorney because, not every attorney speaks to you, to the clients like they're not an attorney. Like you explain it in a way they completely understand. And I love that because not all attorneys do that. And a lot of people, I'll get calls, well, my attorney, explained this, but I didn't really know what he was talking about. And I'll explain certain things to them, but they get that from you from day one. And, that's one of the things that I get a lot of feedback on is they love that. So
I really appreciate that. Yeah, it's just something we're passionate about.
Mm-hmm.
I mean, I love to have the conversations about home ownership and home success because at the end of the day, if you can't feel comfortable in the investment that you live in or the investment that's supposed to be deriving income for you, it really just doesn't make sense, right? Why would you do it? And I think that's what's brought about this disheartened generation that we see today where, they're just reluctant to get into it. It's too complex. It's too expensive. They're inundated with other necessities and demands of life, and they just put this sort of thing aside. And I can't say it enough that you've got to get in early. You've got to get in at a young age and do the responsible thing when it comes to your home because there is no more valuable investment that you could make in your future, in your sanctuary, than owning your own home, right? Your solitude comes from the place that you live in. And if we could make it something that's understandable, affordable, and within everybody's reach, I think we could say we've had some pretty successful careers.
I agree. And I always try to tell people who are renters and, I'm going to keep rent, just go through the pre-approval process. Like, let me show you what that actually looks like so you can really compare apples to apples. All right, well, for $2,000 a month in rent versus, $2,000 a month in a mortgage payment, let's see what that really looks like right now. Plus, there's obviously we're not tax advisors, but there's a tax deductible aspect to owning a home that there is not with renting. So $2,000 a month in rent versus $2,000 a month in a mortgage payment is not an equal. It's not equal because you're getting write-offs over here on the mortgage. So your net may really be like $2,500 a month versus $2,000 in rent after you've written off, all this money off your taxable income. So, that's the thing too. I think people should get pre-approved by, someone like Forte Financial or whoever they're going to use, and then discuss with their their accountant or tax advisor, their tax deductibility. Because clearly we're not licensed to advise on tax matters, but we want to educate and make people aware that is something that they need to be aware of when making a decision. Because I think most people don't factor that in. They just think, 2,000 is 2,000, and it's not in this case. So
yeah, absolutely. We advise people to own real estate investments that derive income from people paying rent, and it's really to try to get people from not paying rent. The only circumstance that I see as reasonable to rent is when you're not sure you're going to stay in that geographic area. So young person's going to school, or you're in an area because you have a short-term employment in the area. Those are the kinds of things where rental scenarios to me make sense. Outside of that, there's just no reason why you can't own a home today. No reason at all. A semi-responsible credit score and a marginal down payment gets you in a position that's better than paying rent anywhere. Period. There's not an alternative to that. If you could make it income-producing property because you don't have any other demands like school-age children in a particular area you would want to be in, that's an example where you might say, hey, look, I'm looking for a single-family house because I want my kids in a particular school system or a district. That's a consideration. But if you don't have that consideration, buy a multifamily in the most tenable community you can find. That's where you want to make your first investment.
Like I said, I wish I had this advice truthfully, because my first home purchase was a condo, and it didn't even cross my mind that I would be able to qualify, because I'm like, I don't make enough money. I don't make enough money to qualify. And yeah, I wish I did.
Right.
Because I probably would have paid $150,000, 25 years ago for a four-family in Danbury, Connecticut, which would be worth what, $500,000 or $600,000 today.
Very easily. A four-family in Danbury is worth more than that.
Exactly. Yeah. Yeah. That's what I'm saying.
Yeah.
So, generally real estate appreciates. You're going to have these crashes, like 2008, but over time it just goes up. Right. So.
Well, this has been great, James. I really appreciate the opportunity to talk with you. I hope that we can do that again sometime, and maybe on some other topics like 1031 exchanges, because that is, if we have a doubler in real estate investing, that's the quadrupler.
We've done some clients together mutually that I've seen how you've advised them, and I've seen in one case in particular, a gentleman who owns a very expensive home in New York that he ended up selling, and through this 1031 exchange was able to buy many properties here in Connecticut. And I know now he's making an incredible amount of money per month cash flow that he was not making in New York, and there was no tax implications based on the 1031, and that's awesome. I've seen it. So we should I'd love to do another one of these on 1031s for sure. Yeah.
Sounds good.
Anything else you want to share with our viewers that you think might be good?
I think if we did, we'd be into another half-hour conversation.
All right. Well, thank you, Anthony. I'm so grateful you came on the show today, and hopefully, viewers, you got something positive out of this.